There are a lot of stocks out there that you can choose from to invest in, but there's one stock that I think is primed to surge moving forward throughout the rest of 2026. Why? Because it has strong business momentum, because its valuation is very compelling, and believe it or not, the technicals are even getting on this company's side. Now, I won't hold you hostage. The name of that company is Sea Limited, a company that primarily is in Southeast Asia and has an e-commerce company, Shopee, a fintech company, Money, M-O-N-E-E, and a gaming company called Garena. Now, believe it or not, I revealed to members of my investing community, Stock Investing Mentor, at the beginning of August that I thought Sea Limited was the #1 stock that I would choose if I was starting a new portfolio today. And since I talked about that, the company has returned over 24%, whereas the market in general has just returned 4%. Now, most of that came after the company reported earnings with a strong surge, but I still think this is a very attractive stock moving forward. Let me show you why I think that. My name is Brian Stoffel. Of course, at the time of this recording, I own shares of Sea Limited. So they recorded their second quarter of 2026, roughly an $80 billion company. Look at this. Revenue is not only growing fast, but it's reaccelerating. Revenue growth came in at 48%, way ahead of analyst estimates. Earnings per share was up only 8%, which actually missed analyst estimates, but by and large, investors were willing to cut them some slack. And we'll see that play out here. So gross margins came down, operating margins came down, net margins came down. Now, why are these things happening? Well, if you follow Mercado Libre, it is a very similar playbook on two prongs. First, Shopee, the e-commerce division, is investing heavily in logistics and lowering the thresholds to allow same or next day delivery throughout mostly Southeast Asian companies, although they also have operations in Brazil. That lowers margins, but expands the volume of revenue coming through. The second reason is that the company is expanding its credit portfolio, its loan portfolio, its buy now, pay later portfolio quite quickly, and that takes time to become profitable as well. So this is not unexpected to see margins coming down, and the company can largely fund it. It's not anything to be worried about. Free cash flow is strong, albeit not increasing very much. Net income is solid, although not increasing very much. The balance sheet is in great shape with roughly $7 billion net cash on the balance sheet. If we look and go down the income statement, we can see that play out here. So the revenue was up 48%. The cost of that revenue was also up 48%. So net, this actually wasn't that bad. That's why gross profit grew by just about as much as revenue did. The part where there was some deleveraging was in operating expenses, and they didn't actually grow all that much faster than revenue. There was just a whole lot of growth in sales and marketing and a whole lot of growth in some of the provisions for credit losses. Beyond that, the spending was actually pretty stable, and those credit losses make sense given the fact that their credit portfolio is growing. So that's why operating income was only up 33% despite revenue growing 48%. And net income is affected by a whole bunch of things. That is less concerning for me. But to get a better idea of what's going on with Sea Limited, we should go on over to fiscal. So I pulled up a couple of different things over here in fiscal. The first thing that I want to bring to your attention is just the different business lines. And this is revenue, not profitability, but revenue. And so what I want to show you here is that Shopee, the e-commerce, is definitely the largest portion of the revenue, followed by Money, the fintech services, and then Garena. And if we want to know how fast each of those are growing, because that's really important. And so is this. If you look at Shopee revenue, it has not only been growing, but accelerating its growth pace to 48% in the most recent quarter. That is really impressive because this is one of the key linchpins of an investment in Sea Limited. Money is doing quite well too. Its revenue growth was 59%. It's been holding above 50% for well over a year and a half now. So that business looks good. And then Garena, which might appear to not be that important, has actually experienced robust growth for 5 quarters in a row, coming in at 34% growth during the quarter. But that's the revenue piece. It's important to understand the profitability piece. So what I've pulled up here is operating income for each of these divisions. And while Garena was the lowest in terms of revenue contribution, it's the highest in terms of profitability. Now, I personally am not invested in Sea Limited for the long-term potential of their gaming division. But I am cognizant of the fact that the gaming division is what's necessary to fund the investments, the moat-building investments in e-commerce and in fintech. And those two are the long-term reason that I'm holding shares of Sea Limited. And what you can see that's really great is that ever since the holiday quarter of 2024, all three divisions are profitable. If we look at Shopee, you'll see that the operating income was relatively flat from the year ago period, and that's fine with me. This is where they're making heavy investments right now. If we look at Money, we see that their profitability is also, it's slowing, but they're making heavy investments right now. The fact of the matter is they're profitable. That's what really matters. And it helps that the profitability of Garena has really been booming lately, up 46% from the same time last year. A couple more metrics worth hitting on. First is bookings for Garena, because remember, we need Garena to be healthy over the medium term to fund the expansion of Shopee and Money. And what we see is that this is going pretty well. Bookings are up 15%. And remember, that's basically money that Sea Limited has collected. It just hasn't been recognized as revenue yet. So that's the Garena division. The other thing that I want to point out is GMV. That's a gross merchandise volume of everything sold on Shopee's marketplace. And as you can see, for the past 5 quarters, it's been growing at a steady 28%. And it did that again this quarter, selling roughly $38 billion worth of goods on the marketplace. The last thing that I want to point out is perhaps the most impressive, which is the take rate. Now, what this means is you take that last number I showed you, GMV, and I say, well, how much of all that stuff being sold, how much of the money trading hands does Sea Limited and Shopee get to keep? Because way back in September 2023, their take rate was just 11%. But now it's up to 14.6% based really on 2 things. The first is their advertising business, which was up 70% during the quarter. And the second are marketplace listings. They've raised the prices for listing things on Shopee's marketplace, and they haven't lost customers. That, if nothing else, is a sign of a moat. And the investments in logistics are important because it differentiates and builds a barrier to TikTok Shop in Southeast Asia. A couple other things that are worth noting. The company was very clear that they are gaining market share in both Southeast Asia and in Brazil. And they believe that Shopee will have a profitability, 2 to 3% profitability margin, an EBITDA margin, by the end of the year. It is much less than that right now, and that will be less than it was last year, but that's a trade-off for investments in growth that I think is worth it when you see GMV growing as fast as it is. Now, Shopee said that their new buyers, their net new buyers during the quarter was up 35%, the highest growth rate it's ever been, and their members of Shopee VIP, which is kind of like Amazon Prime, reached 15 million people during the quarter. This is a relatively young program. It was up 45%, not year over year, but quarter over quarter. And those VIP members now account for roughly a quarter of all the things that are bought, all the GMV on Shopee's platform. One other note is that in Money, the fintech arm, loans, their loan book was up 62%. But this is really important. Their non-performing loans actually dipped to 1%. Now, some of that is because when you're growing the loan book really quickly, the denominator grows and the non-performing loans haven't had a chance to grow. But the fact that it fell is, all things being equal, a reassuring sign. Now, the company doesn't release any type of forecast moving forward other than saying that they expect GMV to grow 25% for the full year. I think that they will be well ahead of that and those EBITDA margins that I talked about. So what am I going to watch moving forward? Well, first is that GMV growth. I want to see it be above 25% for the full year. Second is the Shopee take rate. Going from 13-ish to 14-ish% was huge. If they can hit 15% by the end of the year on a quarterly basis, that would be a huge sign of the moat that Shopee has built. Third is the growth of Money's loan portfolio, and just as important is keeping an eye on those non-performing loans that Money has. I want to see them stay as close to 1% or below as possible. Without a doubt, there is business momentum here. The moat is widening. The only reason I say cautiously optimistic is because we have to see how that loan book performs over the long term. But there's two other parts to this. One is the valuation, the other are technicals. Now, before I get to that, I want to say that if this type of analysis interests you, then you should join the community where I revealed this pick at the beginning of the month. Stock Investing Mentor. Comes in three parts. The first is access to my real life portfolio. 90% of my family's net worth in this portfolio. You see what I'm doing, when I'm doing it, with an explanation of why. Second, you get access to the anti-fragile stock universe. Every stock that I own and follow rated for anti-fragility and valuation, as well as the three most important things to watch. And 1 hour of live weekly training that's recorded if you can't make it, and 24/7 access to a private online investing community. And not only that, you also get Stock Simplifier Pro, a $400 value, absolutely free. If that interests you, then click the top link in the show notes below to get 10% off an annual membership. Now, I promised you that we would talk about valuation. So what I've done is I've gone over to Stock Simplifier Pro right here. This is a tool you can use to look at the business, figure out what you think of the company's moat, which, by the way, most importantly, Stock Simplifier believes is widening. But I'm going to go to valuation here. And what we're going to do is we could look at the company's PE ratio, currently trading at about 50 times earnings, or their price to free cash flow, trading at 15 times free cash flow. But because it's a fintech company, I don't think that that's really helpful. What is really helpful is to look at this on a reverse discounted cash flow analysis. Now, here's how this works. The first thing that we have to do is we have to say, what could C Limited's optimized free cash flow margin be in the future? Now, it's currently at 19%, but the fintech arm makes it look higher than it really is at a steady state. Now, I would say if I was being super bullish and aggressive, I could give them a 15% margin, but I'm going to pull their optimized margins. Look at this. I'm going to pull it all the way down to 10%. So what that means is once the credit portfolio's growth kind of stabilizes, it's not growing by 60%. Once GMV growth kind of stabilizes and all the different parts of this machine are contributing as much as they can to free cash flow, I believe 10% of all revenue can become free cash flow. I think that's being pretty conservative. It's about half of where it is right now. And I'll also give the company a 3% terminal growth rate, which is what I give companies when I believe that they have a wide moat. So here's what this number right here means, 12.4. That means that if C Limited can have that 10% free cash flow margin, and if it can grow at 12% per year revenue growth over the next 10 years, well, then this is at least a market matching result. Well, what do we think of those assumptions? Does it make sense to say that they could grow 12% per year? Well, we can look at history and what analysts believe moving forward as, a gauge. And so what you see here is revenue growth over the last 10 years. And you can see that back in 2023, revenue growth did stall. It was just 5%, but it has been accelerating and accelerating massively over the last 3 years. Not only that, but over the next 3 years, analysts expect it to grow revenue by 32, then 22, then 16% over the next 3 years. I actually think that's lowballing it, and I'll show you why I think that. I think analysts have regularly underestimated what this company can do, and that shows. Look at when that orange line shows analyst estimates for revenue last year. When they started making estimates, they said $16.3 billion. It ended up being 22.4. That's in a different zip code entirely. When they started making guesses for this year, they said, they'll get $23.1 billion. They're all the way up to $30 billion now. So I look at those growth rates, and to me, I say to myself, I think that they're lowballing it. I think that the company can definitely, over the next 3 years, have 25% growth per year. Here's why that matters. We go back to our reverse DCF, and what I'm going to say is that over the next 3 years, I believe that the company can grow revenue at an average of 25% per year. So let's play this out here. The stock already went up a whole bunch, And yet, if we give a 10% free cash flow margin, which I think is conservative, a 3% terminal growth rate, which I think is middle of the road, the near-term revenue growth of 25%, maybe you could say that's aggressive, but I think it is justified. Well, then C Limited only needs to grow its revenue by 6% per year from years 4 through 10. I think that's a very easy bar for the company to jump over. So that makes me pretty excited about owning shares as well. And you can even do a little bit of very, very rudimentary technical analysis as well. And what I want to show you here is that this purple line is the 200-day moving average. The orange is the 50-day moving average. And you'll see two things here. First, that the 50-day is about to cross the 200-day, otherwise known as a golden cross. But also, the stock has gotten above a rising 50-day, and the 200-day is about to be above a rising 200-day as well. Now, those are all short-term in nature, but you stack all of these things together. The business anti-fragility momentum, the valuation over the next 10 years, and the technical analysis, and I believe that this is a stock that is set to surge. Let me know what you think about C Limited in the comments section below. Until next time, Brian out.